Hello, everybody. Good afternoon, or good morning, or good evening, indeed, depending on where you are at the moment. And thanks very much for joining us on this webinar where we're going to discuss the do's and don'ts of buying an HR technology company. We're still waiting for some people to join, but whilst we do that, I'd just like to say thank you very much for joining us. And also thank you very much to the panelists for their taking up their time today as well and sharing their experiences and insights of acquiring businesses, especially in the HR technology and work tech space. Just a quick note for those of you that are listening, if you want to ask any questions throughout, there is a chat window on the side of the screen which you can use. Type those in, and then our producer Dawn, who you can't see and is in the background, will moderate those and pass them over to us during the session. A lot of them might actually be integrated within the core questions that we're asking, and if we get to the end of the session and we haven't answered your question, then we'll do it offline with you through the guys that are on the panel. We are a bit time limited. We've only got about 45 minutes. So I was going to crack on to start with just with some quick introductions so that you get a flavour of the experience of the people that we've got on the panel. I'll start with myself. I'm going to moderate the session today. My name's Howard Flint. I'm the CEO of AMP Strategist, and we are a boutique advisory focusing on advising scaling HR tech businesses. Those businesses that are looking to take the next step to get greater revenue, greater profit, greater business value. And as part of that as well, we advise on M&A buy side and sell side. So as you understand, this is something that we're personally as a business very, very interested in. Perhaps I could pass it over to Will for a quick intro and your background. Thanks, Will.
Sure, absolutely. Hello, everyone. I'm Will Cook. I work for a private equity fund called Cow Corner, and we're pretty interested in investing in HR technology businesses. We own a few businesses in HR tech and HR services, so it's a market that I've been doing deals in whilst I've been at Cow Corner. Prior to that, I worked for a business called Iris Software Group too, which is one of the more kind of prevalent buyers of HR technology and services businesses in the UK. So I've been in this market for a few years now. I'll leave it at that in the interest of time, but that's me in a quick summary.
I'm sure we'll find out more about your experience, Will, over the next 45 minutes, and I trust that bicycle is actually securely fastened to the wall. So
I hope so.
yeah, right. Okay, next up, Paul. Paul, great to have you.
Hi everyone. Paul Daly. We're currently the Chief Commercial Officer of an organisation called Org Group. You might know them better for one of the businesses which is within the group called Morgan McKinley. Within your group, there are a number of recruiting businesses, BPO businesses, and also technology advisory and strategy businesses as well. My background has really been more than 20 years now in the human capital management and TA tech space in a variety of different roles. I've also been an angel investor in HR tech for the last 15 years. I was also one of the early members of a team of an organisation in the RPO space that then grew into a broader talent solutions and indeed talent technology business as well. We grew up from about 30 people to 3,000. I did a range of different roles there, including leading corporate development for a number of years, where we completed 5 acquisitions, and through that period we had 3 different private equity backers as well. So I was a seller and buyer a couple of times on the journey as well. More recently, in my role as Chief Commercial Officer in Org Group, we've also been focusing on the M&A world, and we've actually just completed 2 acquisitions in the last month. So that's me.
Fantastic. Thanks, Paul. And Dan?
Hi, Howard, and hi, everyone. My name is Dan Martin. I'm the M&A lead at AMP Strategists, working with Howard and the team. My background in M&A and corporate finance started in advisory. I trained at Morgan Stanley and worked in Big Four consultancy for a number of years. after which I switched to be principal as the Corp Dev Director for the digital part of the DMGT PLC group, at a time when the group was buying a large number of recruitment technology companies in particular. So we bought about 10 companies in the space of 3 years, and I led all of those acquisitions. I also saw it a bit like Paul. I've seen it from the other side. I was the managing director of a recruitment technology company that was bought in 2015 by CareerBuilder. So I've sort of very much lived both sides of the transaction, and really happy to be here to share some of my experiences.
Fantastic. Thanks very much, the three of you. And I suppose what comes to my mind as the primary question when we're looking at buying a business in whatever sector is, what are the main reasons for doing that? What are the primary drivers that would cause, I suppose, a private business in particular to buy another one? And I'm going to hand this one over to Paul, actually, if you'd like to give your view on that, being intimately experienced with the process, not only the acquisition, but the thought process behind that. So it'd be great to get your view.
Sure. So I guess my perspective is more as a strategic or trade buyer. And in my experience, there are three main buckets of reason why an organization would acquire. One is financials. So is there a financial arbitrage opportunity that could come about by taking a smaller organization into a bigger organization, and typically bigger organizations have a higher revenue or EBITDA multiple valuation, or it could be a bit of a distressed purchase opportunity, maybe because that startup or scaled business has got to a point they're kind of running out of resources and assets, and they need to get onto a bigger platform to continue to scale. So there might be an opportunity to acquire that at a lower price point than the market will yield in a more sustainable platform. The second one is often because that organization, its potential buyer, doesn't have something, and there's a problem that they need to solve for their customer or for the market in which they are addressing, and they're looking to seek access to new markets, new customers, new capability, new IP, new technology to get them there. And inorganic is clearly a strategy to allow them to achieve that. And the third one, and possibly the most attractive one if you are a seller in the right space at the right time, is where a buyer doesn't want to get left behind. And I've actually got a direct experience of this with one of the investments that I was involved in as an angel investor, whereby Bullhorn, some of you may be familiar, had acquired Textkernel a couple of years ago now because they were really desperate to get into the AI space. And an organization that I was invested in called Higher Arrow was actually acquired by the Access Group because equally they were concerned of being left behind in their area. And indeed, that was a very attractive valuation that they made that acquisition on. So really, if you're in the right place at the right time and there's a buyer that is looking to fill that gap, then that is an opportunity for real high value for sellers in that instance. I think you're on mute, Howard.
And Will, what's your view from the perspective of the institutional side of things?
Yeah. I mean, I suppose from our perspective, we're looking for potential in businesses. We're buying shares in a business. We're not buying 100% of the business. We're backing a management team. We're backing an idea, a product, a go-to-market strategy, whatever it is. So we're looking for potential. I think to an extent, some of the stuff that Paul mentions is still relevant. So if you think about value arbitrage, buying for a relatively low price, and in theory being able to sell it for a much higher price in a few years' time. I mean, that's still something that we think about. We think about how we can add value to a business, which means that the multiple that it might sell for is re-rated. And we're looking for, more than anything else, I think, in what I do. As I've worked in corporate development and I've worked as an institutional investor. And I think one of the key things that we spend much more time doing diligence on from an institutional standpoint is the people driving the bus, because we're not going to do that after we invest. We're going to support. We're going to turn up and provide advice, but we're not going to drive the bus in the same way as a founder manager is. Whereas when you work in corporate development, you can do things to support where people leave businesses because you've got management infrastructure, back office infrastructure, everything in place already. So I spend a lot more of my time these days thinking about whether we're backing the right people.
Got it. Got it. And then in the context of the industry itself and HR technology, Dan, what's your thinking there around why? Are there any particular characteristics about the HR technology industry that make it particularly attractive, do you think, as a sort of a buying ecosystem to get your teeth into if you're looking to acquire?
Yeah, I think the sort of rationale is probably common with some of the things the guys have talked about. I think probably a couple of things jump out at me. One is actually the HR recruitment learning tech space is a really highly innovative industry. I think something that's probably sometimes overlooked when you think about HR technologies is the sheer speed and rapidity that technical innovation happens. And I think quite often there is a real speed to market advantage of buying a product or a business that has a product rather than trying to build that product yourself, get that product ready for market, and then start to kind of build the revenues and scale that solution. And there's also, I guess, inherent in the M&A process, there is risk, but there's probably even greater risk in product build. And if you're buying a market ready product, that I think is a big advantage over trying to do it yourself. From a value perspective, I think the guys both talked there about sort of financial arbitrage, multiple arbitrage, and I think that applies even more in high ARR multiple industries, of which HR tech is definitely one. There are a number of factors that drive the multiple that a company can sell for, that a buyer has to pay for. One of those being scale, another of those being growth, another of those being retention. And actually, acquisition is a great route to driving your growth, a great route to scaling your business, and a great route to making your products stickier by consolidating and integrating them with other products. And those all drive higher multiples for the acquirer. And then there's an immediate arbitrage on buying at a lower multiple, selling at a higher multiple. And I think they're certainly common to HR tech, if not exclusive to HR tech.
Okay. We've sort of made the conceptual decision that we want to go and buy a HR technology company. What are the things that you're actually looking for? You mentioned a few of them, Will, didn't you? I'll go back to you, Will, because you were talking about the management team. Are there any other things that you're looking for that are specifically going to identify a good target versus one that you won't necessarily be interested in? And is there any difference there between the way you would looking at it from an institutional point of view, or if you're looking at it in terms of a trade acquisition?
Yeah. I mean, there's a whole myriad of different things you would tend to look at, as you can imagine. I mean, yeah, of course, the people are super important. There's clearly lots of diligence that goes on when businesses are acquired, whether they're being taking investment from a financial investor or whether they're being acquired by a trade buyer. And you go and, I mean, for an HR technology business, you would do a lot of diligence on the product, right? So you can work, even from the outside, you can tell what the product does. You can tell the people are buying it. Often, if you're a corporate, you can see that you're losing business to it, so you must be okay. But then once you get into the weeds, once you get into diligence, you bring technical heads in to actually look at the code base, understand how the technology is built. You get a better feel for whether the product is really strong, it's really scalable, whether actually it's built on sand, or if it's somewhere in between, right? So that's just one example of where you have an idea about how something may be, and then as over the course of a period of time that you do diligence, you may either something might diligence up, and you may realize it's actually a bit better than you realized, and that's quite nice because you may have priced it as a slightly lower value asset, and the opposite can happen as well. So you go through a process of working it out. I don't think that the process of diligence differs materially between corporate development and private equity. If I'm totally honest with you, I'd say that there's perhaps a slightly different focus of diligence from a private standpoint. Yes, it is more focused on the people and the potential of to add value, whereas from a corporate development standpoint, it is more focused on how big is the synergy here? Like, is there more here that we can do to help this business grow faster? Are there things that we can do to help save costs? They become clearer through diligence, and that's how you work out if you've got a lemon, or actually if you've got yourself a decent deal.
From a financial perspective, are you looking at a sort of minimum scale normally in terms of size and growth and the business fundamentals, if you see what I mean? I mean, is that critical? Or is that
I mean, so in my current role, I mean, we have we have parameters. So every fund will have different parameters. From our standpoint, we want to put probably somewhere between 10 and 20 million behind a business in the initial, as an initial check. So the business has to be of a certain size in order for us to do that. We're pretty agnostic in terms of revenue, headcounts, level of profitability. We don't mind looking at businesses that are loss making as long as there's a route through to profitability. At the same time, a lot of businesses we look at are already profitable. So we're relatively agnostic on lots of different things. And then again on things like you talked about growth as well. So we are again, it's more about being able to see growth in the future as opposed to the business being growing really quickly today. Frequently, you'll see businesses with really, really good products, but they don't have a good enough commercial function. So the founder may be a technologist by trade, and he's built something absolutely extraordinary from a technical standpoint. But the go-to-markets, there's a lot that you can do to improve the business from that aspect. So you can see potential, and that's the kind of key criteria, I suppose, as opposed to the business delivering a certain amount of growth historically already.
Right.
The different funds will look at it differently as well. So some funds will look for much more mature businesses. They'll look to put bigger checks behind businesses.
Okay.
But we're perhaps sort of slightly more towards the growth equity end of the spectrum, I suppose.
Yeah, great. And so are there any things that we should consider to be red flags? Anything that when we look at a business we go, oh gosh, we don't want to do that? What do you think, Paul? I'm sure you've seen plenty of these. Yeah. Sorry.
Yeah, sure. I guess, and this is with more of the strategic acquirer lens on. But firstly, there's a big question to be raised around the team and what's going to happen to the team post-transaction. Are they staying? Are they going? Are they staying for a period? And what kind of stability is within the team today, and indeed the founders? I had a live example a couple of years ago when we were going through diligence with a potential acquisition, and both the founders wanted to have a one-on-one with me. Fine. And it transpired in about 5 minutes of those conversations that they absolutely hated each other. But they were both integral to the business going forward. So their reason for transacting was to be able to get as far away from each other as possible and, of course, get out the business as quickly as they could. So lo and behold, that didn't go much further because they were pretty integral to what was going to happen to it on day one going forward. So team is one. Obviously linked to that is culture. And if you think about any kind of integration of two businesses coming together, are they going to come together or are they going to fight with each other? As good as the product is, as good as the go-to-market is, as good as the value proposition is and the market potential ahead, if the teams aren't going to gel, then you're probably going to not achieve any of the synergies that you set out to do. And then the other factor is really just integration considerations and priorities that may be going on amongst the buying organisation. So we all know that the priorities for strategics that are looking to acquire change over time, and they often think, do we buy or build this capability that we might need? And 1 minute their focus on the strategy is here, and another minute it could be somewhere else. So as you're going through that acquisition process, making sure they're going to stick the course and the post-transaction synergies will be realised is pretty important. And then the final flag from my perspective, and this really relates to, again, going through the due diligence process, is how is the performance of the potential business to be acquired trending over that period? And what I've often seen is as soon as the founders start to get distracted by DD activity, the trading performance drops off, customers drop off potentially, the go-to-market slows down. And that to me is a bit of a concern, one about the sustainability of their market, but also about the sustainability of their business if those founding team members are slightly distracted with something else. And there's been 3 deals that I've been directly involved in where we were absolutely gunning to do it, but we could just see the actual commercial performance trailing off, and we were pretty concerned that was going to continue post-transaction. So those are some red flags. There are many, but those are typically how we bucket them together.
Okay, that's great. We've got a question from Amit at Iona who's saying, I'm going through a potential acquisition. Early discussions. What are the key things a founder should think about or consider? So that's from the other side, I'm guessing. Amit, is that right? This is if you're going to be acquired. Dan, I'm going to throw that one at you, a fastball at you, looking at it from the other side. What should a potential founder looking at being? We've been talking about buying a company. If I'm being bought, based on what we've been hearing so far, what are the things that you think need to think about?
Yeah, I mean, I think there's a big question about readiness. Are you, as a business, actually at the point that you're going to be maximising the value for your business if you sell at this point? One of the red flags that Paul didn't mention, but for me, kind of I always look at is how easily and quickly can a selling business get key information to you, like what are their financial controls, management information, all of that stuff. What is that like? And if someone can't get me that in a timely manner, that for me is a red flag. So as a seller, I need to think about, okay, if that's a red flag, how set up am I to be able to respond to the inevitable questions that the buyer is going to raise to me? Is my business plan robust, nailed down, secure? What are some of the factors that buying companies look at and have thresholds on that might put off a buyer if I don't hit those thresholds? So within HR tech, a lot of the time people look at retention rates, for example, and if a business doesn't have a retention rate, and there are different retention rates, but if they don't have a retention rate in the 90% kind of levels, that's just a threshold that some companies have to hit in order to move that acquisition forward. So am I hitting those thresholds as a selling company? Is my financial performance robust? Do I have too much client concentration in certain areas that, again, might mean that when we get into the diligence or once they start asking deeper questions, they're immediately going to be put off by that. And actually, I've spent a whole load of money on advisory fees and lawyers and time and effort on diligence and putting my information together. But actually, the deal was never going to happen because my business isn't strong enough to go through a sale at this time.
Okay, that's good. Thanks for that, Dan. I hope that helps. Thanks, Amit. Going back to the buying side, on the side of looking at it from the perspective of the buyers, then, Will, I'm assuming that, especially in your sort of corp dev experience, you might be approaching companies that actually weren't expecting necessarily to sell. So is there a right way or a wrong way to approach a founder, do you think? Well, how does that work?
Is there right? So no, there isn't. Which is that's cop out answer. But I think the things that I think things that I think about personally when I approach. So I do a lot of reach out to people, see if they want to have a bit of a conversation. You do have to be a bit shameless on that front when you're trying to generate an M&A pipeline. And the things I tend to think about. I mean, I'm not a particularly big fan of generic emails out to people just to see what comes back. I'd much rather spend a little bit of time thinking about what my market looks like and what type of business I might be interested in, and trying to be a little bit more focused. And then in turn, when you do speak to people, you do drop someone an email or you ring them, or however it is that you get in contact with them. If you say, I'm really interested in speaking to you, I know this about your business, this is why I'm interested in speaking, this is who I am, then you get a much better hit rate. So I think that's probably if you're going to do cold reach out, I think that's got to be the way you do it. And then just be persistent as well. So there's nothing wrong with being a little bit shameless and following up and saying, look, I'm not sure if you've seen my email or I left you a voicemail. It'd be great to have a conversation if you're open to having a chat with me. But then I think the other sort of the final bit I'd mention on that is there a best way to reach? I mean, the best way to generate conversations is through warm introductions. So I expect the most of the opportunities that I end up actually transacting on tend to be situations where I know someone who knows someone else who's helpfully put me in touch with someone, and eventually you generate a network that feeds you with opportunities, and that's always going to generate the best type of conversation, because the person who you're being introduced to, they already have a kind of a reference on you, so to speak. So that tends to work. So go around, meet as many people as you can, and be a bit shameless. If you want to introduce someone in the network, just ask. And if you do it tactfully, people are usually pretty helpful, especially in HR tech, where people are trying to innovate, people are trying to be helpful, they want to make friends. So I've always been an advocate of doing that sort of thing for other people, but then also I do it myself too.
Yeah.
Can I also jump in? I think I think that's they're all really good points. I think the other point for me is a bit of authenticity as the buyer. There's the old saying, people buy from people and people sell to people, and that's definitely true. If you can build a relationship as a buyer, whether you're in private equity, whether you're a strategic buyer, if you can build a relationship with that target company, be authentic, be honest, share information with them as well as ask information from them. That really makes a huge difference. And there are loads of examples, and I've had it myself, where you can win as a buyer, not at the highest valuation, if actually the company that's selling sees that the fit is really strong, the relationship's going to be strong, they're confident in your ability to transact, and they're confident in how you're going to behave in the transaction. It makes a huge difference. So I think if I take someone like Will, that sort of personal approach, being personable and building relationships with people, that's going to win every time.
And Paul, do you think a strategic acquisition gives you a certain is it advantageous if you go in with that type of approach, do you think, as opposed to
I think it can be, and one of the other strategies, which isn't exactly rocket science, but I've used quite a bit, is starting from a point of view of partnership before acquisition. So if you're looking at a potential target at another point in the value chain and you're not a direct competitor, then you can get to try before you buy, and actually integrating them with your client services and helping them understand the market that you're serving, and to frankly do some BD on them up front, can be very helpful. And in those scenarios, you obviously typically reduce the chance of a straight shootout scenario where they're actively auctioning the business to the highest bidder, because you're already kind of working together anyway. And secondarily, you can really get a march on better deal structures, because typically in that scenario, the seller will see the future potential together. So typically the opportunity for lower upfront consideration, higher earnout comes about because they can see 3 years down the line their business can be significantly more valuable being part of you for that period, rather than just seeing it as a point in transaction. So in about 70% of deals I've done, partnership has predated getting married, i.e. actually doing the acquisition for that reason.
Brilliant. That's a really good point, I think. So we've acquired our target, we've talked to them, and there's a definite interest to move forward by both parties into an acquisition. We then start talking about the deal structure. And for an amateur acquirer, Will, what does a deal structure consist of generally? What are the elements in it?
Yeah. I suppose the deal structure, in simple terms, it's how much money you're getting on day one, and then how much money you're getting after 12 months, 24 months. You can structure deals over 5 years. Sometimes I've seen that before. And then there are other elements of it as well. So some of the consideration that gets paid over can be in not just into money up front and earn out, but it can be into shares in the business it's buying if you're a corporate buyer. So there's various different elements or ways that you can pay for a business, and so that's basically what the deal structure is. And then in particular on earnouts, I find it gets pretty fiddly in terms of how they're calculated too. So you can also describe the way that earnouts are calculated as the type of structure you're putting in place, and some of them can be really hard to hit, and some of them can be really easy to hit. And generally speaking, if you've got a buyer, like Paul, for example, that may structure earnouts more frequently than I do, I'm guessing, correct me if I'm wrong, but I'm guessing if you can pay for something over a longer period of time and it's harder to hit the earnout, you can pay a bit more, because you're mixing the risk you're taking with the price you're paying. The way that you price risk is reflected in the deal structure you've got in place. The way I tend to kind of think about it, just to summarize, is if you've got someone that's kind of got an appetite to take risk and wants to earn more over a longer period, you can pay more. If you've got someone that just wants to take their chips off the table, then you might be able to pay them more up front, but you can't pay them as much. So that balance, striking that balance and developing a set of rules around it, around how amounts of money are paid, is what the deal structure is.
Yeah, I imagine that's pretty critical actually for the company that you acquire, for the individual that you're acquiring. What are the key things that you would think about when creating this ideal structure, Dan? What are the factors that you'll be weaving into the deal?
Yeah, I mean, it's very similar to Will. Really, you're basically structuring a deal in order to take account of the things that are, I guess, important in that deal, and the sort of risk factors in that deal. So if you take, we'll talk there about deferred consideration, and deferred consideration can be kind of an earn-out structure, or it can just be delayed payments based on hitting certain milestones. But deferred consideration is really important when maybe you're not super confident in the business plan of the company you're buying. You like the asset, you like the business, but you're concerned that maybe the plan is overly optimistic in certain areas. Well, tie an element of the consideration to performance against that business plan is a nice way of doing that. Will touched on this as well. Valuation. Sometimes it's really easy to put a high valuation on a business if you then defer a lot of the consideration and you put milestones against it. And some sellers are going to be really motivated by that headline valuation. So if you're pushed into a valuation as a buyer that you're maybe not super comfortable with, a great way of responding to that is deferring some of the consideration. On the flip side, if the synergistic value of the acquisition is really great, and as a buyer you're super confident in those synergies, you know that there's immediate customers that you're going to be able to introduce this product to. There's immediate synergies that you're very confident in gaining. You might want to steer clear of too much deferred consideration, because actually, ironically, you're going to end up overpaying. Things like how important is the management team to the acquisition. Much of the value of that acquisition is maybe relating to near-term or mid-term product development or new features. If either of those elements are really important, earn-out suddenly becomes a really good way of kind of managing that. If you can tie significant portions of the consideration to specific earn-out targets that keep the management team properly motivated, you're going to keep that key asset well involved in the business and delivering what you need them to deliver. But you've also got other things like management control. How integrated are you going to make this business into the bigger entity? How much do actually you want to just keep it as a standalone company? You love the business plan, you love the management team. Actually, in that situation, you probably have to give quite a lot of management control in that acquired company for a period of time. But you then put structures around that in terms of, if certain milestones aren't hit, certain metrics aren't hit, then as a buying company, you've got the ability to step in and take control if you're not happy with the direction of the company. But really, you're factoring in a whole range of factors when structuring a deal. But it's all about protecting the downside risk and delivering the upside potential of that business in terms of coming up with those elements. But you've got a whole load of other things that take account here as well. Things like asset versus share. There are circumstances where you might want to buy the assets of a business, not the share capital. If you're buying assets out of a company, that's a good way of doing it. If you perceive a high amount of risk in the original entity, you might de-risk it by buying the trade and assets rather than the share capital of that company. You need to think about things like non-competition, non-solicitation. All of these aspects play to structure when coming up with the deal.
And what about in terms of valuations then? Because this is normally the tricky thing, I imagine, when you're having these initial conversations with a potential a company that you could potentially acquire. Where are valuations at the moment? Where would you see those in the HR technology space? I think some of the expectations from a few years ago haven't yet subsided. Is that right? In terms of multiples, and how would you go about evaluation exercises? It would be interesting.
Yeah, I'd love to get Will's take in a minute about what he's seeing in the market as well. But I think why are kind of HR tech businesses typically valued highly, and most tech founders of HR tech businesses probably have some really ambitious targets in their mind. They're probably thinking, I might be able to generate 4, 5, 6, 7, even 8 times ARR, which as someone that trained in investment banking and valuing companies based on fundamentals is a really hard thing to get your head around. All valuation should be some form of discounted cash flow. And as soon as you're talking about multiples of revenue, that feels very distant from discounted cash flow. But the reasons that those metrics are often used is because HR tech companies, SaaS businesses as a whole, tend to have very high degree of operational gearing, operational leverage, which means that future growth, a large amount of future growth falls to the bottom line, falls to profitability. And so when you're at a relatively early stage and you're a growing business, actually revenue is a much better proxy for future profitability than you think it is from the surface. HR tech businesses tend to have some really good business fundamentals alongside that operational leverage. Retention rates often very high. Really hard to switch out your payroll provider. Really hard to switch out your benefits provider. There's a high degree of integration within client companies of HR tech businesses that makes it a very hard thing to unpick and switch out. Market conditions are pretty positive. I would say most businesses need some form of HR system in place. It's pretty difficult to run your business without payroll, very difficult to run your business without benefits and other HR tech systems, whether you're small, whether you're an enterprise company. So there's a big market to go after. There's lots of new emerging markets within the wider addressable market. The world of work has changed significantly in the last 5 years since COVID. It's opened up whole areas like employee engagement, performance management, that yes, they were important sectors before, but they've suddenly become even more important and they're growing really rapidly. It's also an industry that's very focused on consolidation and integration. And again, integrated solutions, very hard to unpick, very hard to churn away from. So there's a whole range of things that I think make it a valuable sector. Where those valuations are now, my view is we haven't really yet seen a significant drop in the values that good quality assets are achieving. I think we've seen a definite drop in which businesses can generate those multiples, which businesses actually have a home at the moment versus 12, 18 months ago. There feels to me like there's a massive flight to quality. 18 months ago, I think you could have probably had maybe slightly suboptimal growth or slightly suboptimal retention rates or suboptimal scale or whatever, the key things that drive value. You could probably be down on one or two of those. Right now, I'm not sure you necessarily find a great buyer for a business if you're missing those key attributes. And I think that's probably particularly true with private equity. I think there's a feeling that there's a load of money sat in a load of private equity funds needing a home. And I think that's clearly true. But I think the risk profile, the risk that private equity companies are willing to take feels to me to be lower than it was 18 months ago. But I'd love to get Will's take on that.
Go on, Will. Right now, what's really going on?
No, I can't speak for the entire industry, right? But yeah, I can certainly give it a go. I think Dan's summarised it really well. Valuations for HR technology businesses are really high because the services that they provide, the products that people buy, are absolutely mission critical. You need to pay your staff. You need a core HR system. Progressively, you'll need learning management, performance management, and all of these things that weren't as relevant 10 years ago are now absolutely mission critical. It just lends itself to high valuations for businesses that are built properly, that are growing, well run, and fundamentally software technology businesses when they're profitable have very high margins. That's obviously very, very good when it comes to producing cash, which ultimately, to Dan's original point, drives the ultimate valuation, or should do anyway. But yeah, in terms of what's happening in the private equity market, I think you're absolutely right. There's much lower appetite to take if you're going to pay a really high multiple, there's much lower appetite to take a risk on a business that you don't know is absolutely definitely one of the premium businesses out there. I would say that in the height of I remember in 2021 there was a very very high number of transactions and high valuations, and I think people got quite excited by the idea that that was the new normal, and if they bought something at a high valuation or a slightly toppy valuation, they might be able to sell it for a slightly toppy valuation in a few years' time as well. Whereas I don't think today, when I think about who's buying HR technology assets, I can't imagine if I buy something that's a little bit shaky, that's got a bit of technical debt that we can't really fix very easily, it was expensive to fix, or the people aren't quite going to deliver the growth that's required to get that high valuation in a few years' time, then you're not going to find the buyer. So the eventual exit kind of drives the appetite to invest on the way in. And it's all markets are so fickle, right? So if that changes and suddenly there's a boom in transactions in HR technology, then I expect some people will suddenly start getting comfortable with paying up for slightly more middle of the road assets, even though they probably know deep down that it might change in a few years' time. But that's just the nature of these things. Sometimes these markets aren't super logical, and they do work in cycles. So I think we're at a point in the cycle where you can still sell your business for a really great number if you've got a premium business. But if you haven't, then there's much less of an appetite to do deals. But yeah, wait a year or two and see what changes, and you might have a better market to sell or improve your business.
There's another element I think hasn't yet played through that I think is going to be really interesting to see, and that's going to be the impact of AI on SaaS business models. And there are whole areas, I think, in if you take recruitment, for example, that recruitment businesses are typically being built. I mean, again, Paul, you worked with them, you've built them. They've traditionally been people first businesses supported by technology. As they rebuild post the current economic challenges that they're facing, will they grow back with the same number of people they had before, or will actually they be using technology, using AI in a very different way? And actually, most SaaS businesses operate some kind of user license model. And what is AI going to do to that? And will AI first businesses are clearly going to attract premium valuations if they've got the model right, but what impact that will have on more traditional HR tech businesses, I don't think we yet know. So I'm not sure we've really seen the full impact that it's going to have on those business models.
Yeah, definitely. Now we've got another question. I'm going to read it out. It's a little bit long, but I think it's worth it because it's an interesting question, I think, posed to especially you guys who are experienced acquirers. So this is from Mark at Create LMS, and he says, we are tiny. We've built a very robust LMS LXP tech stack that scales and slowly develops it over many years for Comcast and their 330,000 learners since 2017. We get approached frequently to sell, but the multiples aren't worth it. A new client just left a big competitor of ours after 12 years and cannot believe how strong we are. The competitor was Tachebo. When I look at the financials and money wasted, cost of support, they would save a fortune if they used our product. Is it possible to reform a big competitor's stack by adopting ours? In other words, would acquirers ever look at a product? I think what you're saying is, Mark, would acquirers big acquirers ever look to buy a smaller company's product because it's better as part of, say, a product refresh? Who wants to have a go at that? Paul?
Yeah, I mean, I'll jump in and say the short answer is yes, and there is some precedent for this in the market. I mean, there's companies like Lumeus, Mr. Ted, and others in the ATS space that kind of acquired each other to get a leg up on the product. But I would say the valuation is going to be capped in that approach because ultimately they're just buying an asset which they then need to integrate and create value from for their business going forward. That is to say, the cash flows from that acquisition are going to be pretty limited at the point of transaction. So you've got to decide whether your tech and product is unique enough such that a incumbent would choose to acquire your product and then put all the go-to-market machinery around it to build it out, or whether you're better to continue down the path you have of getting at least one big customer with Comcast and maybe a couple of others as well. So you actually have a proper business that could be seen as a competitive threat to one of the incumbents, and they want to take you out of the market for that reason, rather than just acquiring your assets and your product. Of course, that second path has risk, time frames, etc., that you'll need to consider. So that's kind of part of your calculation you'll need to work out.
Okay, that's. I hope that's answered your question, Mark. Now onto the final one for us. Whilst acquisition can be effective, it comes at a risk. So, and obviously there are a percentage of deals that do fail. Why is this, and how, as an acquirer, can you avoid this? And Paul, I'm interested in your thoughts as you're in the middle of these maelstrom of deals.
Yeah, I guess a number of things here. Firstly, the buying behavior of buyers can sometimes be more emotional than we would want to believe. That is to say, whilst there is good rational consideration over why a deal is to be pursued, sometimes there's a mandate from the CEO or the board just to get things done. In the example I shared earlier, there was concern of being left out by an organisation, so they just wanted to acquire a business in the space, so they didn't feel that they were going to get left behind. That may or may not be a rational thing to do from a financial perspective, but they were just concerned with the path and trajectory of markets, that if they didn't do that, they were going to face a problem. That's one. Secondly, when you consider the baseline expectations that are normally set when a deal goes to the board for consideration, there are normally some pretty lofty expectations around synergies, particularly revenue synergies. We think we're going to put our customers together and all of a sudden they're going to sort of 5x the revenue from them. Reality is that's difficult to do. Customers change their mind. Customers don't like the idea of having limited choice in the market, etc. So actually realizing those synergies can be pretty difficult. But also post-transaction, all the energy that was going to go behind integration can sometimes dissipate. Other priorities come up, different people get involved, and all of a sudden that energy goes elsewhere. And I think one of the classics was when Randstad acquired Monster back in 2016. I mean, Monster was a pretty strong asset in the job board space. It hit very tough times. LinkedIn obviously really had quite an impact on where revenue in that space goes to, but nonetheless, Randstad obviously had a plan to do something with Monster, maybe integrate it into the value chain. A couple of years later, as we know, they pushed that business out into Career Builder, and last month the whole thing folded. So it can certainly go pear-shaped pretty quick, and obviously the plan that they'd set out to achieve in 2016, either they couldn't realise it and some of their deal thesis was off, or other priorities got in the way that meant really they just looked like they had a lame duck on their hands that they wanted to move on from.
Brilliant. Any other thoughts on that, the pitfalls for acquisitions, or we've got another? Dan, did you want to?
Yeah, no, I agree, Paul. And one of the things that I think works really well is having a deal skeptic within the organisation. So someone that, because you do get caught up in an acquisition. You've put a lot of time and effort. You're excited by the potential. Having someone in the organisation whose job it is almost to say, ask the difficult questions, not get caught up in the hype. I've found that incredibly useful in the past.
Okay, there's one word I always find is a deal killer, which is legacy. When it comes to when you start talking to people as well, and that's quite a tricky thing to get over. I think when you're buying or trying to acquire a business, and there is a high proportion of focus on the legacy aspects of that, which might not necessarily work as an acquirer. Now we've got one more question from Glenn. We are a SaaS with an expert service model, meaning we provide the expert consulting support for our employees, for employee experience and an org diagnostics product. Are buyers interested in these types of blended tech service models?
Yeah, so I'll kind of pipe up just with a start for 10 here. So I think it depends on who the buyer is. And if that buyer is a business that has a service and product mix themselves, the answer is probably yes. But typically, if you're a pure play SaaS business, having to rely on arms and legs and beating hearts to actually get the job done is less attractive. It impacts GP, it impacts scalability, and of course, you've then got more dependency on the talent to actually get the job done. So you've got to decide what the market expectation is for what you're offering. I don't know the niche you're working in, but it may be a niche where people are integral to the actual product. If you're in a bit of a island in terms of having that mix of people, services, and technology, then that might limit your potential pool of acquirers. But certainly, I'm not saying shy away from it. Just be mindful that it will only be attractive to certain types of buyers because of your business mix.
I imagine there's a valuation implication here as well. Yeah.
I mean, I was gonna just say that, and I was going to ask Will's view, but my view absolutely is they will, sophisticated buyers will look at your business. They will look at the different revenue streams, and they will apply different multiples to different parts of that business. Will, you've probably seen lots of these.
Yeah, I mean, as a starting point, I'd say a combination of software and service can be really, really effective as a model, and you may be able to take your business much further with that model than you would if you were only selling product. So you might, even if you can't necessarily get the best multiple of ARR or EBITDA or whatever, you might have a much larger business by virtue of the fact that your delivery model is got services in the mix as well. So I'm personally a big fan of the combination of the two. I think it's most services businesses over time will naturally become more kind of technological, and so I do think that it's something that can create a really, really powerful business model. I suppose, to your point, there are characteristics of having services in your mix that means that there's more risk around it, and the margins are a bit lower because people cost more money.
But I think just
hosting software. So.
Sorry, Will, could I question?
No, go for it.
In terms of if you've got services, the chances of having a bigger stream of revenue is greater, and even if you've got a lower multiple on a bigger revenue, you've probably got a bigger valuation overall. But what I would say is, do not masquerade as a product business if you're not a product business.
Not a product business, exactly.
And quite often, organisations that are going for sale will try and put a bit of lipstick on the pig in that regard, and it only takes about a nanosecond of DD to realise that actually you've got a bunch of people doing the job. So if you are a services and tech business, then just be upfront about it, because it'll save you a lot of time.
Fantastic. Look, I'm mindful of the time. We've run over a little bit. I hope that's okay for everybody. I think it's been a fantastic discussion. I'd just like to thank, in particular, all the panelists today. I think brilliant sort of insights and expertise that you've illustrated. I really also appreciate the people that attended and the comments, kind comments, and the questions that you've submitted. If we're going to be recording this webinar, so and we'll send you a link. And if you wanted to share it, by all means, please share it with anybody you think would find it useful. I'm going to do a little bit of a mini plug here for AMP Strategists. If you're looking at buying or selling your business, if you're worried about growth and you want an ear to talk to around how to scale fast in your business, please come and talk to us. We've got another webinar coming up in August, which is going to be around bootstrapping versus getting investment, which I think will be very interesting. And we're going to have a dinner in September in London, which is going to be talking sell side with a successful recruitment technology founder who exited a few years ago. More details will be coming out on that. And lastly, we've got our podcast, the HR Tech Scale Up Show, which is available on all good platforms. I had to say that. But apart from that, thanks very much, everyone. Thank you, Dan. Thank you, Paul. Thank you, Will. Thanks for your input. And look forward to seeing you on our next webinar. Thank you very much indeed. Goodbye.
Thanks, everyone.
Yeah.
Bye-bye.